Hello everyone, and let's talk about the news of the week. It was a roller coaster ride with sudden falls, recovery attempts, and constant sense of uncertainty. The beginning of the week was gloomy. Bitcoin started at around $77,000, rolling back from the highs of early May. And during the week, the price dropped to $74,289, and the volume of liquidations of long positions exceeded $210 million per day. One of the largest blows to the bulls in recent times. But by the weekend, buyers were able to regain about 4% of the local minimum. On Sunday and Monday, Bitcoin returned above 77,000 and the asset lost only about 0.5% over the entire week. But it was very volatile inside. So what happened here? Why was the market so feverish, and what factors will determine the movement in coming days? We'll take everything in order. First, price action and macroeconomics, then the main news of the week, and then an overview of institutional movements, security, and analytical signals. In general, we have a lot to discuss. Please like, subscribe, and let's get started. The beginning of the week, May 18th, Bitcoin opened at around $77,000, continuing the previous week's downtrend. The mood was gloomy and the market was still digesting the inflation data. And during Monday, the price continued to decline, and by evening, Bitcoin was trading at around $76,700. The dollar index rose to 5-week high, exerting additional pressure. Tuesday and Wednesday were the hardest, and Bitcoin fell below 75,000 and at some moment reached $74,289. And this happened against the background of harsh statements by the new Fed leadership. And on Thursday, Friday, the market started to recover, and there was a positive news about the negotiations between the United States and Iran. Oil plummeted by 5% and Bitcoin has returned above 77,000. On Saturday and Sunday, the price stabilized, and at the time of writing, Bitcoin is trading at around $77,200, holding above the 50-day moving average. So macroeconomics became the main factor of pressure on the market this week, and several important events happened here. First, the new leadership of the Fed has made itself felt. The new chairman, Kevin Warsh, has made it clear that the regulator is not ready to ease monetary policy. Fed Governor Christopher Waller called discussions over rate cut madness, and the market reacted instantly, and according to market estimates, the probability of a rate hike by December already exceeds 70%. Just a month ago, mind you, the market was planning a rate cut, and now it is a promotion. Secondly, the bond market continues to scare, and the yield on 30-year US Treasury bonds reached 5.14%, the highest level since July of 2007. And this means that investors can receive guaranteed returns from the government without risking anything. Inflation expectations have also worsened, and the April CPI showed 3.8%. And this week, investors are waiting for new data on PCE inflation and a revision of US GDP. If inflation turns out to be higher than the forecast of 3.2%, the pressure on Bitcoin will increase even more. And in the context of a tight monetary policy, Bitcoin continues to be perceived by investors as a high-risk asset, and short-term bounces as an opportunity to reduce positions. But there was also good news. By the end of the week, there were signs of progress in the negotiations between the United States and Iran, and WTI crude futures fell by more than 5% to about $91 per barrel, and this is a continuation of the fall from the level above $104 on the previous Wednesday. The reason is reports that the deal to open the Strait of Hormuz is in the final stages. Let me remind you that the Strait of Hormuz is of critical importance for global oil supplies. Before the war, more than 20% of the world's oil flows passed through it. And US Secretary of State Mark Rubio said that Washington and the Iranian negotiators have pretty solid groundwork, and a deal to end the war could be reached as early as Monday, May 26. Asian stock markets reacted with growth, and the Nifty index in India rose by more than 1%, and while Japan's Nikkei gained almost 3% in early trading. Bitcoin has also maintained a positive momentum. However, analysts urge caution because every report of possible progress quickly lost its impact after denials from Tehran, and market participants have become significantly less responsive to the geopolitical headlines, and most importantly, there is no official agreement just yet. And by the way, if you want to buy and trade cryptocurrencies, I would like to remind you again about the sponsor of my channel, which I used a long time before creating the channel itself. OKX Exchange is the best and most transparent solution for traders today. And if you want to join and get welcome bonuses while supporting my channel, see the link in the description box down below. And now to the main drama of the week, institutional flows. According to CoinShares, from May 11th to May 15th, crypto funds recorded an outflow of $1.07 billion. And this is the first outflow in 7 weeks and the third largest in the whole of 2026. Bitcoin funds lost $982 million, Ethereum funds $249 million, and the largest outflow since January for Ethereum. ETFs on shares of blockchain companies lost $133 million. Interestingly, altcoins have shown resilience. XRP funds raised $67.6 million, Solana $55.1, Ton, Sui, Ondo, Chainlink, and Dogecoin are also in the black or green. A total of 11 assets recorded positive flows. Geographically speaking, outflows accounted for the United States, $1.14 billion. European investors, on the contrary, remained positive. Switzerland attracted $22.8 million and Germany $22. In just 2 weeks, the total outflow from spotcoin ETFs exceeded $2 billion. And this is a serious signal: institutional investors locking profits and go into cash. BRN analysis to note that the key signal for crypto is whether the outflow from ETFs will slow down. Bitcoin can absorb institutional sales if the liquidity of stable coins remains high, but steady outflows will make each subsequent rally more difficult. And despite the outflows from ETFs, the regulatory front continues to be encouraging. The Clarity Act, the main bill on crypto regulation in the United States, remains on the agenda. Analysts remind us that the bill delimits the powers of the SEC, and the CFTC defines the status of digital assets and gives banks the opportunity to store cryptocurrencies. The full Senate vote is expected to take place in June or July, and if the bill is passed, it will open the floodgates to trillions of dollars of institutional capital, and pension funds and asset managers will finally get regulatory certainty. However, investors should keep in mind the risk of buy on rumors, sell on facts. Even if the Clarity Act is passed, the price may adjust after the positive news. And now the news that rocked crypto community at the end of the week. On May 22nd, online detective ZachXBT reported suspicious activity on the Polymarket platform. The hacker attacked the UMACTF adapter contract on the Polygon blockchain. The damage is estimated at between $520,000 and $658,000. Let's talk about how it happened. The attacking address was detected during the systematic withdrawal of about 5,000 POL every 30 seconds, and the stolen funds were divided into more than 15 wallets and sent through mixers and exchange services, including Exchange Now. An important caveat here: the attack did not affect the main user deposits, but the backend dispute resolution infrastructure. And users' fixed assets and the liquidity of the markets were not affected at all. The platform has not yet released an official statement at the time of publication, and the investigation is ongoing. Interestingly, this is not the first incident with Polymarket. Previously, the platform faced an attack on the management of the UMA when a large token holder tried to influence the resolution of the outcomes of political markets. However, the current incident is different. This is a direct theft of funds, not a manipulation of management. But ironically, the platform has already started betting on the outcome of this hack. But there also was a good news in the security world. On May 18th, the Verus cross-chain bridge was hacked. The damage amounted to $11.5 million, and that's about 5,402 Ethereum at the time of the attack. The hacker exploited a vulnerability in transaction notification by forging a cross-chain message. But what happened next is amazing. The Verus team decided not to go to court, but contacted the hacker directly and offered him a deal. The condition: the hacker returns 4,052.4 Ethereum, and that's about 75% of the amount, within 24 hours. In return, he receives a reward of 1,350 Ethereum, and that's about $2.8 million, and the termination of all investigations. And of course, the hacker agreed, and the funds were returned. And of course, the story has caused controversy in the community. Proponents of the approach call this pragmatic risk management, but critics warn that the practice of paying rewards to hackers may encourage even more new attacks. And experts note that the Verus case is a rare exception. Most bridges break-ins end with fund disappearings through different mixers or being permanently frozen. Despite the general outflow from ETFs, some assets continue to attract institutional capital, and this is an important sign. XRP became the leader of the week. The inflows to XRP funds amounted to $67.6 million, and analysts attribute this to the expectation of the Clarity Act, because bill may ultimately clarify the status of XRP. Solana is also in focus. The inflow is $55.1 million. The expectation of an OpenGlow upgrade continues to attract investors. Hyperliquid showed an unusual increase of 7% at the beginning of the week, and the reason is the hype surrounding SpaceX's upcoming IPO. Musk is influencing the market again, even through his companies. BYDFi analysts are paying attention to open interest as one of the most reliable early signs of the new cycle. When open interest recovers from near zero levels to significant values, this often indicates institutional positioning rather than speculative demand. And unlike in 2021, the current cycle does not indulge altcoins. Capital rotates selectively. XRP, Solana, Hyperliquid, and several other assets are showing positive dynamics, but most altcoins continue to trade below their 50-day moving averages. Analysts note that several conditions are needed for full-fledged alt season. Bitcoin dominance should fall below 50%, a stable capital rotation signals should appear on-chain data, and demand for ETFs should expand beyond Bitcoin and Ethereum. And none of these conditions have been fulfilled yet. Ethereum is especially lagging behind right now, and it continues to trade below its 50-day moving average, unlike Bitcoin. Analysts attribute this to the lack of spot demand and positive news. Experts' opinions on the future movement are divided. BitGet analysis are more constructive. They note that Bitcoin is holding above key supports, and institutional purchases through ETFs until the recent outflow are creating structural demand, and their base case scenario is consolidation in the range of $75,000 to $84,000. Analysts at BRN and CoinSwitch urge to keep an eye on two key signals. The first is a slowdown in outflows from ETFs. The second is the finalizing of the peace deal between the United States and Iran. Until the deal is finalized, traders are not ready to fully incorporate the risk. So, what is in the store for the market this week? First, investors will closely monitor the PCE inflation data and the US GDP revision. If inflation turns out to be higher than the forecast of 3.2%, Bitcoin could test $71,000 to $73,000. Secondly, the negotiations between the United States and Iran remain a key factor here. The deal to open the Strait of Hormuz is a powerful positive catalyst for oil and risky assets. Disruption of negotiation, on the other hand, is additional pressure. Third, the ETF flows. If outflows continue, the market may continue to decline. If they slow down, the bulls will have a chance to rebound. And the fourth one, the Clarity Act. The expectation of a vote in the Senate continues to support the market. The bill is a fundamental reason for long-term optimism. But that's going to be it for today. A link to OKX is in the description box down below. Subscribe, click on that notification bell, and I will see you tomorrow. Bye.